Welcome, everyone. Today, we're doing a complete deep dive into the fundamental and technical anatomy of Vimta Labs. We really want to decode exactly what's driving this industry leader's incredible momentum. Whether you actively track the pharma testing space or you're just looking for a fascinating financial case study, you're going to want to hear this. Let's dive right in.
Here's our roadmap for today. We're starting with their core business model, moving on to the financial engine, taking an x-ray of their valuations, checking out the owners, and wrapping up with the technical charts and future guidance.
All right, let's kick things off with Section 1, the foundation. What exactly is their business model and competitive moat?
Now, ask yourself, how does a company operating a massive 600,000 square foot life sciences campus at Genome Valley manage to completely dominate the highly regulated contract research space? Well, it's not just about having a big lab, it's about their razor-sharp focus and sheer scale. Their revenue mix really paints the picture. A massive 70% of their revenue comes directly from the pharmaceutical sector. Think drug discovery, preclinical research, and clinical trials. On top of that, 20% comes from food testing, and the remaining 10% is from environmental and electronics testing. That's a beautifully diversified base that helps them significantly minimize risk. And their strategic moat actually got a whole lot deeper recently. They made a bold move and divested their diagnostics business to ThyroCare. Why? To pivot entirely to core B2B contract research. The result of that laser focus? Their EBITDA margins, which historically sat around 23 to 30%, literally expanded to over 35%. That is a real game changer. Moving right along to Section 2, the engine, let's look at the financial growth powering this company. Looking at the annual comparison, you can see a really solid jump. From FY24 to FY25, revenue grew from 3,223 million rupees to 3,482 million. But the real story is their operational efficiency. Profit after tax soared from 410 million straight up to 668 million. That B2B margin expansion we just talked about is directly translating into fantastic cash growth. And that momentum is holding up beautifully in the latest quarters too. Q2 of FY26 was actually their best quarter ever. Revenue crossed the 1 billion mark for the first time, hitting 1,045 million rupees. Then in Q3, revenue normalized a bit at 986 million, but they maintained a really impressive EBITDA margin of around 37%. Their pricing power is clearly staying incredibly resilient. Okay, Section 3, the X-ray. Time to look under the hood at their debt health and current market valuations. Let's talk about a really crucial number. 0.0073. That is their debt-to-equity ratio as of March 2026. Over the past year, that ratio dropped by over 67%, which means this company is operating with essentially zero long-term debt. From a fundamental risk perspective, having a debt-free balance sheet like that gives the business a massive safety net. Now, let's talk valuation multiples. At a market cap of roughly 2,671 crore rupees, their PE ratio sits at 34.44, EV to EBITDA is around 18, and price to book is close to 6. For a lab testing and contract research organization, these multiples tell us that the market has fully priced in their recent growth momentum and those expanding margins. But here is where it gets really interesting. While the current market price is trading around 597 rupees, independent intrinsic fair value models price it closer to 236 rupees. That means the stock is trading at a massive 153% premium right now. So objectively, you have to carefully weigh this high premium against their zero debt profile and strong growth metrics. Next up, Section 4, the owners. Let's see exactly where the smart money is moving. Looking at the changes between December 2025 and March 2026, promoter holding is rock solid, dipping by a tiny fraction to 35.85%. What's really noteworthy is that both foreign and domestic institutional investors have slightly increased their stakes, while the retail public holding has marginally dropped. And here's another fantastic forensic check. Promoter pledging is at exactly 0%. When promoters pledge shares for loans, it adds risk and volatility to the company. So having absolutely zero pledging is a massive green flag for corporate governance and investor trust. Finally, we reach Section 5, the horizon. Let's look at the technicals and what management is planning for the future. On the technical front, things are looking very bullish. Market analysts are pointing out a clear rounding pattern breakout on both daily and weekly charts. Plus, post-Q1 FY26, the stock showed a parallel channel flag breakout. All of this indicates strong upward price momentum, which is heavily supported by the 20, 50, and 150-day moving averages. But we have to highlight this fascinating divergence. Your technical indicators are screaming strong buy based on pure price action momentum. But on the flip side, fundamental intrinsic models are labeling the stock as overvalued due to that hefty premium. It is a classic battle between technical strength and fundamental math.
So, how is management trying to justify this premium? Through aggressive growth. They've planned a 90 crore rupee general capex for the year. But the real potential growth engine is their foray into the high margin biologics CDMO space, with a 40 crore investment planned over the next 2 years. They expect this new segment to start generating revenue by Q1 of FY27.
So, here is the final puzzle for you to solve. As Vimta Labs aggressively expands its biologics capacity, maintains zero debt, and runs at high margins, will that future growth be enough to justify the premium valuation it trades at today? That's something to think about. Thanks for joining us for this explainer, and we'll see you in the next one.